Natch, thanks so much for doing this again. So we're going to run through the LBO model for sports team. It is Man United, and we've got the template here, which we'll hand out to everyone. We've got the final answer, which we'll also hand out to everyone. But we're going to actually run through the process that private equity companies or like M&A analysts who'll be using LBO analysis would kind of do. So, Natch, I'll let you take it away.
Thank you, Nigel, and thank you for having me. And good morning to everyone. So as you said, I think the key of this analysis is just to look at how would a fund or someone trying to perform a leverage buyout look at the company and what would be the different steps. We won't go into a lot of depth into the financial engineering, etc. But I think it's just to give a quick overview. So the first thing that someone looking from outside at this company and trying to assess whether an LBO makes sense and the returns work would be just to compile all the public information that it's available about the company. If it's public, if it's private, you would try to contact people in the company, people that know the industry, to gather as much information as you can. The key items that you would focus on are, first of all, in this case, as it's a public company, we're just gathering what is the public information. So what is the current share price, shares outstanding, and the market value of the company, and we'll see why. I have a second section here, which is called transaction assumptions, which we'll look into more detail later on. But this will drive what is the price that you are paying and your leverage assumptions at entry and your exit. A bit more in detail, we have the P&L here copied, the last 5 years, just to look at different trends. Something like the business of newsletter will help you understand the company, right? And the idea is that you understand what are the different drivers of the different lines. As you said, Nigel, this is inspired in Man U. These are the numbers from Manchester United, which you've gone through. So I would encourage everyone to go and read the newsletter to understand a bit better the company. We have the continuation of the P&L, which is that key metric as you described in your newsletter, Nigel, the adjusted EBITDA. And as we saw, the fact that this company has negative operating profit doesn't necessarily mean that they lose money every year. There's that point about D&A, right? Depreciation and amortization, which is a non-cash expense. So once you adjust for that, you can see that the company is actually generating cash flow. This would be the metric we're using to base our valuation at entry and at exit. And then we have a couple of other cash flow items on the balance sheet.
Perfect.
So, Nigel, the first thing that we would do is, first of all, calculate what is the offer price, right? So normally in public companies, what you need to do is, obviously there is a large registry of public shareholders, right? Which could be from very small and retail shareholders, right? Like you and I owning a couple of shares, to big asset managers, to even sometimes hedge funds, sometimes family offices, right? That own 5 to 10%. Or in the case of Man United, I know there is what was the name is still in my head.
Family.
Yes, exactly. They own a large piece, but the rest is public. So normally what you would need to do is launch what is called a public takeover offer, a PTO, which means that you are offering the same share price for everyone. Normally it comes at a premium because you're trying to gain control, and control of a company requires a premium, right? As I'm going to exercise control and I'm going to own and manage the company, I need to pay a bit more than someone that is a passive investor. The other way to think about it is you need to offer a higher price than the current trading to convince the majority of the shareholders to sell the shares. Because you need to pay the same price to everyone. It depends on the market, but in general, the rules are you need to pay this. You can't discriminate. Setting and then normally you need to have a minimum take. So you need to be between, I don't know, sometimes the threshold is 90%, sometimes it's 95%, but you need to have the majority of the people, of the shareholders, accepting the offer.
And that comes into here, that box there you're talking about, the offer. It's the offer premium, no, Natch, rather than offer price?
Or... Correct.
premium.
Okay.
Yeah, yeah.
Can you still see my screen? Yeah.
Yeah, I can still see your screen. It's got a bit. Yeah, yeah, I got it. Yeah, yeah. Of premium. Yeah.
Okay. So what we're going to do is just link it, and what we've prepared is a template. But the idea is that obviously, so I'm linking this to the share price, the current share price.
Yep.
And I would encourage everyone to then try to do this at home,
Yep.
and go through the different steps. But
Yep.
the idea is, this is my share price, this is my offer premium, right? The number of shares that I need to acquire.
Yep.
And therefore my acquired equity value,
Yep.
or the price that I need to pay, is basically that share price times one, with the 10% premium times the number of shares. Right? This is
Yep.
the
So
$4.1 billion that I will need to pay all Man U shareholders to pay to buy the company.
yeah, so Natch, just quickly there. So if you go to the first tab, just to make things clear. So the market cap here of the company is around we're saying 3,749 million, so 3.7 billion. And if you go to the second tab, you're saying that to actually buy this company, because the shareholders will want a return, they're not going to give you the company for the same market price. You're going to have to offer 10% more. And so you're going to actually pay 3.7 billion, you're going to have to pay 4.1 billion.
That's right.
Perfect. Okay.
And for everyone's context, there's two more things that you need to take into account here. One is, how has the share price performed? So imagine that the share price has gone down 60% in the last 2 weeks. People will not be willing to sell you the share price at the 10% higher than the last share, the last share price. Why? Because that would mean that they're realizing a 50% loss.
Yep.
Normally, what they would try to do, is try to find the fair market value.
Yep.
And then the second point is that the average take private premium is between 30 and 40%. So this is a low offer premium that we're assuming here. Normally, you could go to 30%, 25%, even 40%. But again, always looking at how has the share price performed, right? The same way, if it has gone through a big rally and in the last 12 months, it has tripled the size, the price, maybe the shareholders are fine with a 20% premium, right? Unlocking all the gain.
You'll see why we use the 10% at the end.
Yes, and it's a bit to look at the returns, exactly.
Yeah. Okay, so let's move on.
Let's continue. So now what we need to do is calculate what is the enterprise value of the company, i.e., what is the total value of the company, taking also into account the debt. So what we're going to do, and that's why we need to get the current balance sheet. So we're just going to add both the short-term and the long-term borrowings, and then deduct the cash. Okay. Okay, so this is the total EV of the company, 4.6 billion. And then what we've done here is we've linked this to the adjusted EBITDA. To see what is the multiple of adjusted EBITDA that we're paying, 57 times. I'm not an expert in this industry. This seems like a very healthy multiple. So probably what this tells me is that either companies trade on a different multiple, maybe it's dividend yield, or maybe it's, I don't know, a multiple of free cash flow. For the sake of this example, we're just focusing on EBITDA, which is normally the most common metric.
Sure. Sounds good.
The other thing that we've pulled here is how much leverage they have, they currently have in the company, so which is 6 times. Now,
which is also slightly high now. A lot of companies.
Yes.
Yeah, which is also slightly high. Okay.
Normally, what you would see is companies that create a lot of cash flow and they have high margins, like infra companies, I don't know, like toll roads, etc., are normally the companies that can cope with the most leverage, and those can go to 10 times. And this is rule of thumb, obviously, it depends on the industry, but this can go up to 10, 12 times. Other companies like retail, where you have very low margins and a lot of cyclicality of cash flows, they normally go up to 3 times. This one is probably something Man United is something in between, because in a way you create a lot of cash flow that then you can always you invest a lot in players, right? But at the same time you can always cut that investment. So okay, so let's look at the next step is what we call the sources and uses, which is in our heads, how much are we paying and where is where are the funds coming from?
Yes.
So
So
the
we've
uses of
said if you just go back, Natch, it's a second
Mhm.
time. We've said the
Yeah,
total enterprise value that we need to pay for this company is 4.6 billion, yeah? And now we're going to work out how we need to actually go about getting that 4.6 billion.
correct.
Okay.
Correct. So normally the way I think about it is first I do the uses, which is, as you say, I need to pay for 4.6 billion, right?
Yeah.
On top of that, there's something which is in our assumption, the 4.6 billion, we're assuming we use all the debt that is currently in the company, but
Yeah.
you need a minimum cash balance to run the operations. So
Yeah.
that is the next item, which is just assuming a minimum cash balance, which we have here. Again, it's just a simple assumption.
Yep.
The other point is the transaction fees. So to perform all this analysis and to get to the point where you are acquiring the company, you need to hire consultants, tax advisors, financial advisors, right? All
Yep.
of that are fees that you need to add to your enterprise value and into your uses, because you will need to fund that, right? On top of paying the shareholders and the debt holders of Man United.
Yep.
So we are assuming it's a 1% of the total EV. And then the last one is the financing fees, which is what the banks and the financing providers, the debt providers will charge you for the debt that you are raising. And
Okay.
that leads me to well, I'm going to leave that blank for a second
Okay.
because then we need to look at the sources. The sources are very easy. You would need to you would try to raise as much debt as you can as the company can cope with, right? You don't want to be with a company too over levered and then be in default 1 month after acquiring it, right?
Right.
But at the
Right.
same time, normally banks don't give you or financing providers don't give you that amount of leverage. Right? So in a way, normally you would just try to maximize as much as possible to minimize the amount of equity that you need to put in.
Okay.
In this case, what we're assuming the company had, if we remember, 6 times roughly,
Yep.
we're going to put 12. And that is one of the features of an LBO. You normally have more debt appetite. And that is also something that happens in private companies, right? As they don't need to report every quarter their
Yeah.
metrics, they are able to get
That's
a
why
bit
I
more.
was, that's interesting, actually, because when I saw 6 times leverage in the first tab or second tab, I was like, that's a bit high, because for me working in like public markets, 6 times
Mhm.
you never see that on annual reports.
Yes.
You see companies saying, oh, we'll target 2 times, 3 times, things like this. So 6 times is huge. We're saying here that the company is going to take. So we're saying the adjusted EBITDA in 2022 was 81 million, and we're saying to fund this acquisition, we're going to take out 12 times that
Exactly.
that kind of cash flow. Okay,
Yeah.
interesting.
And again, the rule of thumb, as you said, and that's exactly right. Adjusted EBITDA is a proxy of cash flow.
Yeah.
In a way, what we're assuming is that lenders will give you 12 years worth of the cash flow that you produced.
Yes.
So, which is very aggressive. Right?
Yeah.
Again, I think this is just an example, and it's just for the sake of getting the returns
Yeah.
and
Yeah.
everything
Yeah.
working. But obviously, it's something that you would need to diligence.
Yeah.
Something that gets lenders very comfortable normally is because of this, right? So I need to fund in total 4.7 billion,
Yeah.
which are just recapping 4.6 billion of enterprise value plus 10 million that I want to fund into the company so that they can run.
Yeah.
There are the financing fees, 1%, 2% of all the leverage that I'm raising, of the
Yeah.
debt that I'm raising, and then 46 million that I would need to pay to the investment bank, the diligence, etc. That
So
is a 4.7.
this is saying that the financing fees there 19 million and the transaction fees 46 million. This is you're paying 19 million dollars to investment banks and the banks for like the financing part of things, and then you're paying 46 million to all the consultants and things like that, right?
That's right. That's right. And I
No
think
wonder, no wonder these McKinsey consultants earn so much money.
you will need to. Can you hear the fire alarm?
No.
Ah, incredible. Okay, perfect. So then we don't need to cut this. Yeah, no, you're right. So all of these macro transactions, they drive a lot of fees for everyone. But at the same time, if you think about them as a percentage of what you are paying,
Yeah.
it's not as much, right? It might sound like very big, but yeah.
Okay.
So I mean, so basically, recapping, we need to pay a total of 4.7 billion, $4,715 million.
Yep.
Lenders are giving us almost a billion, 974. The
Yep.
rest will be equity,
Okay.
right? Equity that we need to put in. which is at 3.7 billion. And this is something that also gets lenders comfortable. Even if 12 times seems like a lot, we are willing to put 3.7 billion,
Okay.
which at the end, right, if the company goes bust, lenders sit senior to equity, so they would get first the proceeds
Yep.
before we do.
Okay.
So there's some cushion, right? That's the other way the lenders get comfortable.
Okay.
Okay. So now
Yeah.
we have our
Yeah.
sources and uses. We know we're going to invest 3.7 billion. The next step is to go through.
What is the next step, Nudge? So like, what are we? So we figured out we need to pay this amount. Now we're thinking, how much can we? If we buy this for 4.7 billion today, we're thinking, how much can we sell this for years down the line?
Correct. That's a bit the idea. Now,
Okay.
as you said, the key is what is the multiple at which I would be saying, what is the valuation? And for that, I need to forecast my adjusted EBITDA. That's one.
Yeah.
And
Okay.
then the other one is, and I think you mentioned this in the newsletter, you need to look at what would be your exit adjusted EBITDA to look at your valuation at exit, but also this company is producing dividends throughout the period.
Yes.
That would affect your return, right? So you would need to model also the cash flow that this company is generating to see whether you're getting dividends or investing into the company throughout the period, right?
Okay, fine. So Nat, so when you're trying to model adjusted EBITDA, obviously as a private equity analyst, M&A analyst, things, you're looking what are the drivers for this company's adjusted EBITDA? And because Man United is a public company, it makes sense to why don't we find analysis from equity research analysts? And so what we've got here in this tab here, the financial statements, is we've got, as we saw in the first tab, we've got the historical data up till from 2018 to 2022, and we've got the revenue line, but then we've also got the three main revenue drivers for Man United: commercial, broadcasting, matchday. We'll dive into that in a second. And we've got the main like expense lines. And then the forecasted lines, 2023, 2027, they come from estimates that we've made in the drivers column, their drivers tab. There you go, Nudge. And this is kind of like, this is very rough, but this is kind of like how an equity research analyst would look at things. They'll break down Man United's revenues into commercial, broadcasting, matchday, and then within commercial, they'll dive into it as well. So within commercial, commercial is basically like sponsorship that Man United brings in. Their main sponsor is Adidas. So basically, Adidas have signed this agreement for 75 million a year, saying we're the only ones who are allowed to basically distribute your shirts, and then Adidas make money from all Man United shirt sales. And so we can see that Adidas is making 75 million a year in June 2022. And what we're saying is that contract runs out in 2024. So it's 75 for 2 more years. And then we're saying in 2025, a new contract is signed either by Adidas or by Nike, and they're going to be paying higher than that. They're going to be paying 125 million. And then we're saying that in the last year, the
last year,
company, when they've bought them out, they might look for a bigger contract as well.
Exactly. And I think the idea is, obviously, you don't, as you said, right? You want to reflect reality. What we are, and this will make sense when we go through all the assumptions, right? But what we're trying to do is assume the exit comes and is an opportunistic exit, right? So you sign a big contract, and that is the year you try to exit.
So we're saying the people who buy Man United here, they're looking to exit in 5 years in 2027, and they're saying we're going to sign a big agreement before that. And so we see Adidas. Well, I won't go through all these lines here, but you got the main shirt sponsor, which at the moment paid 47 million. We're saying that goes up gradually. Second shirt sponsor was Tezos, which goes up gradually as well. And then we can see other lines. We're saying with the Premier League. So the Premier League media rights contract runs out in 2024. At the moment, Man United make about 140 million. We're saying that goes up in 2025, 200 million a year. And so you can see the kind of estimates that we make. And like just one on the cost line. If you look at the cost line for the biggest cost Man United have are their men's squad wages. I put benefits here. They have about 25 players who get paid 8 million a year each, which works out to about 155,000 a week. And we're saying that will go up maybe 6% a year. So in 2027, football players on average might be making 208 grand a week. And that's how the costs go up. So all of this basically to say, If you go back to the financial statements
Yeah.
tab, yeah, all of those drivers make up our forecast from 2023 to 2027. So you can see that because that's linked to the tab. And that takes you to the operating profit line. And that's where I'll hand back to you, Naj, because in the interest expense and tax expense is more back into your realm.
Yeah. So and that was very helpful. What you said is exactly right. I would go with my company and different advisors into each one of these lines and try to forecast it in a lot of detail, right?
Yeah.
And then the second point is also do different scenarios, which you also do in equity research, right?
Yeah, for instance, like like for the Champions League one, you might say in a bear scenario, Man United might not make the top four for 2 or 3 5 years, and so they won't make the advertising and not the advertising, the broadcasting revenue from UEFA. But you might say in a bull case, they might win a Champions League, and so they make loads of money from. I mean, that's not going to happen, but in a bull case, that could happen. So sorry, carry on, Mitch.
So yeah, we went through the P&L, right? The profit and loss. As we've seen, that is a good representation of the result of the company. But there's two big items that we are not looking at here. First is the operating result, but it's not the cash flow generation, which is what you care about in an LBO.
Yeah.
To bridge that gap is the amortization and depreciation. The other point is we stopped at operating profit, but obviously operating profit is everything that is from the unlevered piece of the business.
Yes.
The levered piece would be leverage and taxes.
Yeah.
Right, which are the two other lines that we're going to forecast. So let's start first with the amortization and depreciation. What we've done is that is all driven by the amount of players that you buy, what is the book value of those players, and how you amortize that. The way it works for football clubs, they would pay, and I think you had this in your newsletter. They would pay 100 million for Pogba. I think it's 100, but maybe it was more. I don't remember now.
I think it's like 90 million.
Or 90, and then they would say, I'll sign a 5-year contract. So I would amortize that over 5 years. And then at the end, I would sell it for, say, 70. There's one piece that is interesting, which is all these large clubs, they normally lose money on sale. So they normally acquire for more money than what they sell. And it's just a reflection of acquiring players that are either at the heyday or they are very young and promising. And then normally either they don't work and they need to sell them at a discount, or they have a very long career and when they sell them, they are 35, 34, and they go for a lower price.
Estimate for that here, right?
Exactly. So the way we've done it is, okay, first of all, let's try to think about, we've pulled here what is the historic price that they've paid for intangible assets, right? And we've assumed how many players they've acquired. To be honest, I didn't go into much detail, but that means that on average they've been paying 35, 74, 46, 30 million. I'm trying to per player. So I'm going to assume an inflation per player, an inflation on the average cost per player of 5%, let's say. And as we know, it's just because the players keep the price per player keeps rising. And that means that if I take the average and then I just assume some inflation, I can forecast roughly what is the price per player. The other thing that I will do is we're assuming there is large investment from the new shareholders at the beginning to get a good squad. So I'm going to assume we sign more players than what we sell. So that we hire 4 players, which is a bit more than the average for the first 2 years, and then we keep just hiring 3 players.
Okay.
And then for the players sold, what I'm going to do is we sell less players than what we are acquiring. So the squad is increasing in volume. And then in this year, right after 3 years, when the squad is consolidated, I go and I right size the squad to my average number of players. And then I just continue selling the same amount of players. So I'm buying and selling 3 and 3. As I said, the other big one here is what is the difference between the price at which I acquire and at which I sell. I'm going to assume a 70% discount.
Yeah.
Said
So
differently,
saying if you buy a player for 100 million, you'd sell him for 30 million.
correct. And on average, I would be buying players at 46 to 50 million, as you can see here,
Yes, yes, yes.
but selling them at 15. And you see that, right? In Man U,
Yeah.
they
Yeah,
normally have
that happens.
3 in, and the total equity, the total cash check is $184 million.
Yeah.
And then they try to get some sales, but normally they don't get more than 40, 50,
Yeah,
60
yeah, yeah.
million.
Yeah.
Um, so what is the important thing is not only forecasting the capex, so the amount of money that goes out of the door, but also that amortization schedule. So what
Yep.
I've done here is a very simple schedule where, first of all, I take the existing balance. So the existing total asset balance, how many years will take to amortize that? I'm assuming 6 years.
Yep.
This is just an assumption, but that means that I have 124 million per year that I'm amortizing on the existing balance.
Yep.
And then whatever I'm adding or reducing that balance with the sale and acquisition of players
Yep.
every year. So that net 143 million the first year. I'm
Yep.
going to
Just to
amortize
be
that
clear, just to
over
be clear,
5 years.
just
Yeah,
to be clear. So that 743 million you've got is the end of period. So like in 2022 on the balance sheet, that's what intangible assets will be. 740
correct.
million. Okay. And then you're saying that goes down because like there's an amortization schedule that goes down by an equal amount every year for 6 years. And you're saying then in the second year you add on 143 million because we've seen there you've paid 184 million for players, 4 times 46, and then you've sold 3 players for 41 million, 3 times 14. So that gets you to 143. And then that 143 again, you amortize equally, but you're using 5 years for that.
Correct. And it's that average of 5 year 5 year contract. And as you say, yeah,
You're
it
saying a
is
player contract, you're saying an average lasts 5 years.
correct.
Yeah,
And
okay.
just to go through the motions, the ending of period intangible asset balance, it actually comes from the balance sheet. So it's that intangible asset number,
Yeah. Yes. Yeah.
right? The last year. And then what I'm doing is every year I add to my balance what I'm acquiring.
Yeah.
I reduce by the amount of that I sell, and then I amortize the piece, right?
Yes.
The fact that this is decreasing might mean that we are being aggressive on our amortization policies, which, as we'll see, all that does is, as this is an expense,
Yeah.
it reduces your profit and it creates a point where you are not paying taxes
Oh, yeah,
because
yeah,
you
yeah.
have a negative profit,
Which is a good thing, right?
which is something, well, depends. Depends what you think about paying taxes, but normally something that we try to avoid. Yes, we try to minimize the amount of taxes that you want to pay. Yes.
Okay. Okay. Cool.
Okay. Now the other piece, as we said, so we've done amortization. We've looked at taxes. Let's go back in a second, but let's look at the interest expense. Debt, very simplistically, what we've done is just link this to our acquisition leverage, so the 974 million that they're giving us,
Yes.
and then the cost of debt is calculated. Is normally there's two types of cost of debt, two types, very simplistically speaking. One is the floating, which goes, it's just a margin on top of the LIBOR, and the other one is fixed, right?
Right. Okay.
There's other ones, but I think simplistically speaking, those are the two main ones. Here, what we're assuming is just a floating rate above the US LIBOR of
Yep.
3.5%.
Okay.
So what we've done is from Bloomberg get the curve of what is the LIBOR, that again is, in a way, it mirrors the expectations from the market of interest rates
Right.
hikes and decreases.
Yeah.
And then what we've put on top is what the bank gives us, which is the 3.5%. So a bank, very again oversimplified, would make money on this margin because
Yep.
they are lending and borrowing at the LIBOR roughly,
Yep.
and they make money with a 3.5% margin. Okay.
Yep.
So we're
Perfect.
paying an all-in cost that is increasing of between 6 and 6.5%, which means we're paying between 60 to 63, 58 to 63 million dollars of interest per month, per year.
And that's where.
What
Okay.
exactly? That goes after our operating profit to give
Yep.
us the earnings before tax, and that is the basis upon which you pay taxes. We don't make any profit here. We don't make any money, so we don't need to pay any taxes, right?
Yep. Clear.
and that is our net income. What I've done here, very simple, is just go from net income, go back to what is the real cash flow, and start there our cash flow statement. Again, I'll go very quickly, and we can please send questions if anyone that is watching us has any specific questions. But going from top to bottom, some people start with EBITDA. I prefer net income, and I go net income. That's my profit, and that's my operating results, right? At the end of the year, I'm going to add back all the expenses that are non-cash, amortization and depreciation. And then I'm going to take out the profits that the profits that are just on book, which are that profit on disposal of intangible assets, right? To get to what is my cash flow from operations. From there, I'm going to look at my cash flow from investments, so the capex, right? Which is very simply the money that I spent in players minus the money that I get from players, from the sale of players. Then I'm going to look at the debt. So again, some of this acquisition of players, what you could do is raise even more debt, right? Because you are increasing the value of the company. So you could go back to the lenders and say, look, I want to raise even more debt. Same point, you're increasing your adjusted EBITDA. So for example, here where you've more than doubled your adjusted EBITDA, you could go back and say, hey, can you give me another 12 tons on my new adjusted EBITDA and refinance the debt? But for now, we're assuming no additional debt, and that gives us the equities.
That's the zero there. No.
Exactly. It's just a simplistic assumption. Again, we can go into that in another session. Then my black is the same way in the sources and uses. I have all the money that I need to fund, right? In the acquisition. The amount of debt that I get, the rest is equity. Here's the same. In this given year, my first year, I have a gap of 89 million that I need to fund. The majority of that is driven by the amount of players that I'm acquiring. This requires me to do an equity injection of 89 million. The following year is similar.
Where does that equity injection come from? From the people who've bought the company?
From the fund, in this case, from the shareholders.
Okay, fine.
Again, when the viewers receive this Excel, we can go into more detail on the assumptions. But the idea is that we are investing in the company to turn it around, get that additional contract from Adidas, get more money from sponsorship, more money from the tickets on the first years, grow the operating profit, which is what is happening, right? The adjusted EBITDA has a big jump from year 3 after all this period of investment. Then after that, we're harvesting a bit more the company. And what we're doing is assume, if we remember, in this year is the year we're selling 5 players and only acquiring 3. And then just harvesting the company, start getting dividends out. And you can see that here, right? Is that 74 million of dividend that I'm getting out every year.
These are dividends.
These are dividends,
Equity distribution. Okay, so we've made in that third year after acquisition, we made 73 million cash at the end, and we're giving that out. We're taking that as dividend.
We're taking that out completely.
Okay, perfect. Okay,
makes sense. If the other decision that we could make is just keep it on balance sheet and increase the cash balance. That's why we have here the cash balance, but that is not very efficient, right? I prefer to take it out and then in 6 months inject more money, because in that period I could invest somewhere else, right? Rather than having it sitting in the balance sheet.
Okay, perfect. So that's why in that cash balance, you have end of period 10 million, because we said we'll have minimum 10 million at the beginning of operations, but then that stays as 10 million because if there's a loss of cash, we put equity in. When we're making cash, we're taking it out as dividend.
Correct.
Okay.
Correct.
Perfect.
We could build a function where you accumulate cash on the years that you are creating cash, and then you use that cash to fund the business when you have when you have a funding gap. Okay. So then let's just look at the returns, which is the last piece.
Okay, so just quickly, Ash, before we return. So what we've done now is we've said we need to buy this company for 4.7 billion. I think we said.
4.7 billion.
7 billion. We've said, okay, what can we sell this at? Well, first we need to figure out how much cash flow we can make from this business in like 5 years' time, and that's why we've calculated that adjusted EBITDA and then the cash flow. And now we're thinking, okay, now what price, what multiple can we sell this at?
Exactly.
Okay.
And as a reminder, we bought this company at 57 times adjusted EBITDA.
Yep.
So what we're going to assume now in our return stat is, first of all, we're going to plug in what is our projected adjusted EBITDA, as you just said. I'm going to link this to that. But that, assuming an exit multiple of 45 times, just because we are saying we can play around with this. This is just an assumption, right? But what we're probably going to say is that it seemed to the 57 times was probably too high in the cycle, right? So we need to assume something a bit more realistic.
Yep.
That is roughly our projected enterprise value at exit.
Yep.
Or roughly, that is our enterprise value at exit.
Yeah.
Now we need to, obviously, at exit, we will need to repay the debt. So I'm going to link that to the debt, to the end of balance debt. We will be able to use the cash on balance sheet, same way we had done it in at entry.
Yep.
Right. And then there will be some transaction fees, the same way with that exit. Someone will need to help us sell this company. So I'm going to do a 1% of the EV again. I'm sorry, that should go negative. And that is the equity that we're receiving at exit. There's something funny going on here.
You have to pay that transaction fee every year.
No. So we're just assuming if we were to sell in 2023, right? I've flagged here already what is my entry. From my entry, I would pay 3.7 billion, then pay another 89 million that year to acquire players, and then I would only get 4 billion back. But that goes even worse on the second year, where my adjusted EBITDA goes down slightly. As my multiple goes down, right? If I were to plug here 57, all of these would change. Right? So I have a 57, I still make money on my first year.
Yep.
And even in the second year, probably. But as I'm assuming that 57 was somehow distorted, right? And too high.
Yep. Makes sense.
Makes sense. Yep. Now, it's what I have here is plugged in the different years, right? So, and just to go through it, I have my entry, and then I've plugged in what injections I need to do every year and what distributions I need to do every year.
Yep.
What would be the value I would sell at each given year, right? Yep. And that way I can calculate. So say, for example, I want to sell in year 2025, which is the first year of dividends, and that year where we have the large distribution from selling more players, right? Yep. I would be making 30% annual return and 2.2 times my money, which means I'm investing a total of 3.9 billion and getting 8.5 billion. So I've multiplied my money by 2.2 times.
Yeah.
If I were to wait until the last year, that year 5, where we had the last contract from Adidas coming in, I have a lower return because of the time value of money, a lower percentage return, but I'm able to multiply my money by 2.7 times. So I'm investing roughly 4 billion. You can see it here in the sum, right? Yep. 4 billion, and I'm getting out in dividends and then at the exit, 10.5 billion.
Yeah, perfect. So that 10.5 billion, just to clarify for everyone, is you get that 10,477 by, if you look up, is 255 adjusted EBITDA times by 45 multiple gets to 11.4. Then you take away the debt, add the cash, take away the transaction fees, and that's where you get this 10.5 billion. So that's what Nacho's talking about. Okay, perfect.
Correct. It's a 10.4 billion at exit plus the 74 million dividends that you get.
Okay, so what we're saying is, all right, if in the 5th year we've paid this well, we're saying just for clarity, we said that we need to pay 4.7 billion, yeah, but here you're saying we're paying 3.7 billion.
Yes, because we're only taking into account your equity. So what we said was the total price is 4.7, but I can fund 1 billion with that.
Yeah.
Which, by the way, we're repaying back at exit. We're paying back that 1 billion of that.
Yes. Okay, fine, makes sense. So we're paying equity of 3.7 billion, and we're getting out 10.5 billion. Okay, clear. Correct. That is basically what this whole LBO analysis is about. Is we've paid this amount of equity. This is how much we're getting out at the end. Perfect. Is there anything else to say?
Yes, 3 key things, right? As you said, the key drivers are, first of all, how much can I grow my operating and my adjusted EBITDA,
Yep.
right? The multiple at which my valuation will be based on.
Yep.
Obviously, the valuation at which I would sell. So if we have 60 times here, that would make you see how returns increase.
Yes.
So the other way to make returns work is if you buy things very cheap and you
Yep.
think you can sell them at a higher price.
Yep.
And then the last one is the amount of debt that I can put on balance sheet. That
Yeah.
acts as a multiplier. So say, for example, if we all remember that 22.3 and the 2.7,
Yep.
if instead of 12, we were to have 20 times leverage, our equity gets reduced to 3.1 billion, right?
Yep.
And then the returns go up
Yeah. Because
to
now
2.9
you're
times.
not paying 3.7 billion equity, you're paying 3.1 billion equity.
Exactly. And even if you need to repay the same amount of debt, the 1.6, there's a multiplier effect at the end.
Yep. Okay, clear. So you're saying there's 3 ways to make returns there, and this whole Excel document kind of shows it, but this tab in particular shows it is increasing operating performance. So you have increasing adjusted EBITDA, increasing exit multiple, or still having a high multiple at the end, and then increasing leverage. So
Correct.
you're paying this equity at the beginning. Okay.
Correct.
Incredible.
And these are the three ways investment funds make money. It can be a very good company growing a lot, but if you pay too much,
yeah,
you don't make your returns. It can be a company that is very cheap, but if no one is willing to give you money and lend you, and you're not able to raise debt,
yeah,
it does normally it won't have as good returns as somewhere where you can leverage a lot.
yeah.
Right?
And then
So
the
these
third
are the 3 key
about
drivers.
changing the operating performance of the company now, which is why, if you go back to the drivers, why we said, listen, we got to sign a really big contract in that 5th year to increase the EBITDA. Now, we've said here, yeah, Adidas goes up from 75 to 125 to 175 because we're trying to make more revenue for the business before
Correct.
we can.
And actually, let's do something. So what if we want to base here the returns, right? So the 24.3 and the 2.9.
Yep.
Was that a step? And what if we didn't renew the contract with Adidas and we have a lower contract? You see how those returns go down, and you see how sensitive they are. Even if we were to have the same, you see how that changes completely.
Huge difference, isn't it?
It's a huge difference because that 50 million with no cost associated, right? The players is where you are hiring more players, but at the same time you need to pay them more.
Yeah.
That 50 million that has no cost associated goes directly to adjusted EBITDA.
Yeah, exactly.
And that is the play that probably someone trying to buy this company is making, right?
Yeah.
The play is probably, and that's why they do the tours in the US, in China, and right, they try to sell matches to, in exactly the big markets, right? And sponsor as much as they can, because all that is what really drives revenue.
And it's
and that's why, yeah.
Like what you're saying is, if you look at the other lines here as well, if we're going slightly deeper, is if let's say you want to make more money from UEFA or the Premier League, that comes from we need to have a better team to get a better position, so we can get more money, because you make more money the more wins you get, the more higher further you progress in the Champions League. But for a thing like Adidas, it's you're negotiating the popularity of the club. You don't necessarily have to spend much, as you're saying. So like revenue, there's not much cost associated. So okay.
Makes sense. And that's why if you look at some of the acquisitions of football and made with football clubs recently, most of them they will go into big marketing campaigns or in social media, because that is really what is driving your returns. Or one of the big pieces of returns, right?
Yeah. So if you just go to that returns tab again, right? So just the final piece, I guess, is you're saying that, okay, let's say in that 5th year, it's 9.7
billion.
Yeah. 3.1. Can you change the leverage back to 12 times?
Yeah, sorry. What? I think we had it here, right?
Yeah. Yeah, perfect. And then if you back to returns. Yeah, so you're saying that 10.5 billion in 2027, that works out to an IPO price of, you then divide that by the shares outstanding and that gets you to IPO price.
Yeah, the reality is that it doesn't really matter. It was just to show what would be the implied share price increase if this had stayed public.
Okay.
Something interesting is how
No, but when
it
you
looks
exit,
like
how do you actually exit here? You have to either IPO or you have to sell to another buyer, no?
exactly. Yeah.
Yeah. Okay.
The only thing I would say is in this calculation, as you can see, the share price goes down, and that is because we're not accruing for dividends. So we're taking the money out of the company.
Yeah.
But normally the share price gets adjusted by that. Yeah.
Okay. Fine.
Awesome.
Perfect. Anything to
Perfect.
add?
No, that it was a pleasure to be here as always.
Nice touch. Really appreciate it, mate. That is basically, so we'll send that out the template, the final one, so everyone can play around with the kind of levers that we've talked about. But that is basically how you would, think about acquiring a company like Man United, thinking about how you either increase the operating performance, increasing leverage, or increasing multiple, selling it off, and making your return. So
Yeah.
thanks, Mitch. Super appreciate it, mate.
Thank you. Thank you.